Yes. Hello, everybody. Good to see so many of you joining. I can see some of you just joining now. I'm joined by Mike, a property finance broker from James Property Mortgages. Today, we're going to be discussing basically financing your property journey in 2026, looking at various financing structures and strategies of doing this, bridging, standard mortgages, refurb finance, and also looking at the current mortgage rates and market trends as well. This webinar, this masterclass is a Zoom meeting. Actually, it's not a webinar, it's a Zoom meeting. So the format, if you've never joined one of our James Property meetings before, we will have a presentation first. We'll give you all of the knowledge and all of the value, and then we'll also have a little Q&A at the end as well. And we'll be here for about 45 to an hour to fit inside of a lunch break. And then hopefully you'll take something away today that is quite useful. And towards the end of the presentation, guys, as well, I'm going to be touching on a new tool that we're looking to roll out as part of James Property Mortgages. So for new clients, new applications, it's a mortgage wallet. A little application. I'll take you through it because I've been using it myself for a couple of my refinances. So it's quite an interesting tool which just helps you keep track and progress of any mortgage applications if you decide to use JPM for getting your mortgage or bridging finance. So without further ado, I'm going to give you over to Mike, who's going to get into the presentation, and then we'll have, like I said, a Q&A at the end. So take it away, Mike. Cheers.
Thanks, James. I will just share my screen. Hope everyone's okay. Hope everyone can see that okay. So as James has touched on, we want to discuss the opportunities with James Property Mortgages, the service that we can offer, particularly in today's webinar meeting, bridging short-term finance. We will touch on the services that the business can provide across the board. We'll also touch on a market overview, and at the end there will be an opportunity to look at some of the innovative tools that we are looking to bring to the group to help you guys speed up your mortgage process. And again, we'll follow this up with a Q&A at the end. So financing your property journey. Everyone on today is looking to enhance, grow, start the property journey to an end outcome that is personal choice, that is a desire for themselves. No one can say what is right or what is wrong. The bit in between is how you get there. So James Property Mortgages, born from a desire to create a genuine client journey, allowing you guys to achieve your goals. Again, you have an opportunity to control your destiny using bricks and mortar, using assets to get you an outcome that you require and want. Within the team, we've got over 30 years of financial services experience, ranging from mortgage advice, underwriting, conveyancing, and general customer services, allowing us to give you guys an opportunity to progress your applications, whether very basic or complex, across all our product offering. In terms of the team, we've got 16 registered advisors that will give you a personalised one-to-one service once you've completed your inquiry form. They will reach out to you, understand your situation, and they will help you achieve the outcome. Now, not in every instance or every opportunity or time will they be able to assist immediately, but they will be able to guide you, steer you, and give you an idea of where you want to be and how you want to get there. So when the advisors ring you, use their experience, use the time to understand if right now isn't the time for it to work for yourselves, when is the right time? When's that stepping stone? When is that opportunity to progress? Is it a deposit situation? Is it a property situation? We have a variety of products which we'll touch on shortly that cater for a lot of circumstances. And it may well be that you fit within one. It may well be that you don't fit within any at the moment. But from your perspective as clients, want to understand how you get to that end goal, and the advisors there to help. So as a general sort of market overview, the last 36 months have been one of in sort of real intrigue and interest. We've seen the market sort of go from rates of 1% up to 6, 7, 8% and come back down again. I've been doing this 25 years, and I feel my personal thought is that where the market is now in terms of rates is where it will stay. There's been lots of external things, events that have affected the mortgage market and are still affecting the mortgage market, but the mortgage market is resilient. The UK is resilient, and we're seeing that resilience sort of come through with rates stabilising. We've not seen over the last 6 months a lot of rates increasing. We're actually sort of seeing them come down marginally, maybe go back up marginally, but roughly staying in and around the same numbers, if you like, in terms of the low threes, mid fours, depending on where you are product wise or product requirement wise, or depending you are lender fee wise. Within the buy to let rates, we've seen this new change in model. So lenders have adopted the low rate, high fee model, where potentially to get a really, really low rate, you're paying 7-5% of the loan amount to get that rate. Now, everyone's circumstances are different. Some people may want a cash flow, some people may need to cash flow, which are two distinctly different things, because of the stress testing. Now, again, recently we've seen the market change its stress testing because of the recent bank base rate reduction. So the stress testing requirements have come down with individual lender requirements. But again, the lenders have taken to this really, really new high fee, low rate option, purely and simply because it adds an amount of capital to their balance sheet day one when we complete on a transaction. Within that, we've still got the normal product rates, which come with the standard sort of average 3% lending fee. But again, the rates don't mirror the lower high rate, high fee option. And then we've got the options of no fees, which again, in the main are starting with a mid to high 5 rate. We touched on the bank base rate and the stress testing coming down. We are all expecting further cuts in the bank base rate this year. Now, if we'd have done this meeting yesterday, I would have said that probably seemed unlikely with events over the weekend. Following sort of news last night, it may well be that the realignment of things going on throughout the world and some common ground being found between governments that may now happen within the UK. So if there's any sort of further base rate cuts, we're likely to see stress testing come down, which may well be which will be invaluable for properties in the south because of the way lending is against rental income. Not so much in the north, because obviously the yields are significantly higher, and it's not so much impacted by where the stress testing calculations are worked out. And the one thing that, from a market overview, which I sort of stand by and think is a real misconception, is that whenever we see a bank base rate reduction, we as consumers, via the media, via just the general expectation that a bank base rate means that mortgage rates are cut. That isn't the case. from your perspective as clients, as consumers, mine too, the money that the banks use to lend is based against investment funds, is based against swap rates, is based against a number of criteria that isn't measured by the bank base rate. The bank base rate reduction or increase or measurement, if you want to call it, encompasses a lot of financial institutes within the UK, not just the mortgage market. So a real tip is that it for yourselves is that a base rate cut doesn't necessarily mean that you're going to see a reduction in your mortgage payments, unless you're on a standard variable rate or unless you're on a variable rate. And if you want to sort of see, if you want the fluctuation or the flexibility, then a variable rate is obviously a viable option. But off the back of the market sort of crash in 2008 and the lower rates that we've subsequently seen for the last sort of 14, 15 years, a lot of the lenders have now really loaded the variable rates so they don't get caught short with any real reduction in bank base rate reduction. And so it's just there's lots of things to consider, but from a market perspective, a base rate cut doesn't automatically mean that individually, collectively, we will see mortgage rate reductions. So bridging finance, what is it? Bridging finance is essentially a short-term solution to allow us consumers, to buy a property. Historically, bridging finance was used as a stopgap, as a chain breaker, as a deal saver, as an emergency fund at particularly high rates to salvage a deal. That has changed drastically over the course of the last 10 years. Bridging is now a mainstream product because it allows people, individuals, limited companies, to buy assets that are either A, dilapidated, or B, cheap, or require a quick turnaround because of circumstance, and allow people to get the transaction done within the time frame that's needed, or allow them to buy the transaction to go through on the basis that you can't get a standard term mortgage because of the type of property it is or the condition of the property. So historically, bridging was just bridging. Now we have a multitude of offshoots for bridging. And typical of the mortgage industry, there are lots of different terminologies. I try and keep them as simple as possible. The reality is that we've got a standard bridge, we've now got renovation bridging, we've got below market value bridging, we've got title split bridging, we've got development bridging, and then we've got ground up development bridging. Now, within all these opportunities, it allows you guys to identify, and for us as advisors to identify a product for someone in each of those categories. In the main, you may be looking at some standard bridging where you're buying a property at a value, whether it's at auction, whether it's slightly dilapidated. You've got funds to buy it, you've got funds to refurbish it, and you just need to be able to buy it because it doesn't have a bathroom, it doesn't have a kitchen, and ultimately, whatever you spend on it, you're adding value, and thereby either allowing you to sell it on in uplifted value because of the works that you've carried out, or to refinance it, recover the cost of the funds, recover your deposit potentially, and recover some of your renovation costs, and then ultimately let it out and cash flow, build your portfolio, increase your portfolio. Standard bridging, again, historically used to come with quite low loan to values. We've now got lenders doing 85, 90% of the purchase price where we can evidence uplift. Again, something to bear in mind is that 85, 90% is the gross day one loan. It's not typically your net day one loan, because we've got to look at things like, can it be serviced? Do you want it servicing? Would you like to retain interest? Lender fees of typically 2%. So in theory and in practice, what you will find that an 85% loan to value day one bridge looks like is potentially somewhere in the region of 81, 80% day one, and you're covering a difference with your deposit. The lending is at 85%. Now, the hysteria with bridging historically was that it was expensive, and historically it was. Today it isn't. It's realistic for it. It's fit for purpose. We have standard bridges coming in at 0.7 a month. We have other bridging companies, depending on the scenarios, coming at 1.15 and some even at 1.3. It's all very much product specific. For a standard bridge, I would expect someone to be between 0.7 and 0.95 on today's opportunities. Renovation bridging is, again, it's an offshoot of standard bridging, whereby you are buying an asset, there's an uplift in value, and you don't necessarily have the funds to do the renovation, but we can see from the schedule of works, from the cost of works, that it's a minimal amount to get it up to a standard, because it's just an aged property that needs some TLC. And again, we have lending options whereby in arrears you guys can draw down the cost of your works while you're either A, refinancing, or B, selling the property, so that you're putting the money back in your pocket. And again, typically we have lenders that will be 85% loan to value. Below market value is an interesting one. There's not a lot of opportunity at 100% loan to value, being very transparent. There are a few lenders that will do it, which we have access to. And in the main, they are comfortable at lending 100% of the below market value, where the market value substantiates the higher lending. So if we've got a property at, say, 260,000, that you're buying it at 180, potentially, subject to circumstance, we've got a lender that will lend the 180 day one, on the basis that via desktop or via full valuation, that the valuer goes out and says it's worth 260. Now, that would give you a gross loan of approximately 205,000. Forgive me if my math is a little bit off, but you're looking at about 200,000, 205 gross. Across lender fees and interest, you're down to a net day one of 180. Now, even if you didn't add, if you added some value to that property to get the uplift, then you'd be refinancing at 75% of the uplifted value. And if you didn't add value, you'd still be looking at refinancing at 75 to 8% on a term deal for that transaction. Now, there are other lenders out there that will do up to 90% of the market value. So that widens the scope, but obviously it means that the amount of deposit you've got to put in is slightly higher. From our point of view, we do have lenders where there is a genuine market value price that we can get 100% funding from. So again, for those clients that are short of deposit, the opportunity to find a property whereby there's the ability to either buy below market value and uplift value, there are lending opportunities for you. What I would state is that whilst there is opportunities in that space, funding is required from a cost perspective, in the sense of solicitors, in the cost of surveyors, in the cost of, in the form of application fees. So the costs are significantly reduced, but there is some funding needed to get those over the line. Title split bridging is something that we've done a lot of, particularly in 2025. This is where you have identified an MUFB, a multi-unit building. So say a block of 3 or 4 flats within a freehold building. Typically the flats have their own utilities. We have the one where they don't have the utility, but the clients had funds to put the utilities in after, so the bank lend. You agree a price for the asset, the freehold building with the four flats. And what we then do is we apply the lender, and we apply on the basis that the individual flats, once leases are created, creates a natural uplift in value because you've created 4 entities instead of 1. What the lender does is the lender lends against the uplift in value for the 4 entities. Because essentially, if you've got a multi-unit, and again, just an example figures, you've got a multi-unit that you can get for 300,000, which is essentially £75,000 a flat. But you and your due diligence and your understanding of the market, because of your interest and your desire to sort of work within the market, have identified that flats of this size actually are worth 150, and there's evidence to suggest they're worth 150, thereby creating an asset value of 600,000 across 4 flats instead of 300,000. As long as the valuer confirms that that is worth 600,000 on title split, they will lend against the 600,000. All that needs to happen is that it's a simultaneous transaction. So you buy the property, your solicitor splits the titles out, and upon completion, you've turned 1 asset into 4. From a lending perspective, what we then do is, once Land Registry have done their bit, we then apply for the refinance for you to have individual mortgages, buy-to-let mortgages on those 4 assets, allowing you to pull out the potentially up to 75% of the asset value, thereby increasing your cash reserve or your ability to move on to the next project. So that's title split. And I'm sure there'll be a few questions off the back of that, because it is an interesting proposition.
Mike, we just had one question. It was how many months at minimum can you be given a bridging loan and exit the loan without paying penalties?
So we have lenders that will go up to 18 months, some up to 24. Typically, it's 12. I personally, and I get this across with the rest of the guys in the team, I'm an advocate that certainly won't go below 6 months, because there's just too many risk factors for the client. Clients look at bridging terms and, with the greatest respect in the world, try to save money, which is fine. But going back to your point, the term can protect a client, because if there's any sort of if there's delays with Land Registry, which is a prime example at the moment, the way Land Registry is, if there's a delay with the lending, if there's a delay with the sale, depending on the exit, you do not want your bridge to go to default. We do not want your bridge to go to default, because whilst you might have been on a nice 0.7, a nice 0.9 rate day 1, typically default rates will go from anything from 3 to 5%. So we want to ensure that the term is right, and that obviously the longer the term, James, obviously it's going to impact your net day 1 figure, because it's retaining a lot more interest. So again, it's understanding the circumstances, but typically 12 months. We can go a little bit lower at 9, depending on the strategy and the exit, but we do have lenders going up to 24 months.
Cheers, Mike.
No problem. So in terms of development bridging, this one, in my opinion, people have different takes on it. This one is very much a case of someone that's buying a resi and taking it maybe to a HMO. this is where you're looking to borrow significantly more money because the uplift on the value is significantly different. So again, we've got lenders that will do 75% of the day one purchase. From a lending perspective, again, cost of work, schedule of works, having funding available to start the works because the drawdown payments are in arrears. And ultimately taking maybe a 3-bed property of a size and turning it into a 4, 5, or 6-bed HMO, obviously increasing the rental opportunities, increasing the value. From your perspective, and certainly mine as an advisor, it's understanding the thought process behind it. Is there evidence to suggest the numbers sort of we can get there with the numbers? Is it an Article 4? Is it not an Article 4? Is planning required? Is it PD? These are all the things that we can work with, but essentially we have lenders that will do those conversions, allow you to borrow significant money on the renovation costs and do those drawdowns and typically exit as quickly as it's finished. From a lender perspective on the development bridge, lenders in the main want to see some experience in the sense that you understand how you project manager, for want of better terminology, whether you've got experience of taking a property of that size and turning it into something else and hitting those deadlines, hitting the schedule of works. If you don't have any, then there are lenders that aren't that sort of specific about that piece of criteria, but that will be reflective in rates. It may well be that you bring someone on in the sense that if you've got a build team or you've got a builder or a contractor that you know that you're working with, he might have a level of experience. And again, in the past, I've sent lenders, contractors, builders CVs to demonstrate the sort of work that they've done in the past. It's not a case of they're not able to do it or be able to demonstrate. So your builder's CV is, don't be offended if someone says, can we get your builder's CV? Because the bank want to know that the quality of the work or the experience is there. And again, that then applies to sort of ground up developments. So we're seeing a number of inquiries where people are buying assets with the ability to split land off. We're also seeing inquiries where people are obviously buying land and looking to build per se, but from a smaller perspective, we're seeing lots of people buy properties and splitting land and then building. Again, we've got lenders that will do ground up, funds paid in arrears. So like you need funds to be able to get started. The ground up ones do need a project manager. They do need an experienced builder. They take an awful lot of monitoring, but from your perspective, there are still lots of opportunities. It's not your atypical. It has to be a multinational building company. There are lenders that will lend on ground up developments across the board. One of the other things with bridging is the ability to do a cross charge. A cross charge is an opportunity to buy an asset and use another asset to buy that asset with the equity within it, which is an alternative to taking liquid cash out of your bank for the deposit that you may use for the refurbishment, because you have purchased the asset using the other asset because of the equity within it. Now, typically, in an ideal world, we would use another buy-to-let property. We would use a non-regulated property to do that. However, where there are opportunities where if you've got significant equity in your residential property and the circumstances fit and the numbers work, then we could use the residential property to cross-charge against so that you can move your property transaction forward without without having to use up all your cash. And you've got that to do the refurbishment. The charge would be removed once the new asset was refinanced or was sold, returning the status quo to yourselves for your residential property to be just your residential property with your normal mortgage on. So again, that is another facility within the bridging arena whereby people can start their property journey, grow their property journey because they've got equity elsewhere. The other plus with the cross charge is that you aren't tying yourself into a regular monthly payment because it's a short-term charge. It's built into the facility, which means that you're not putting any financial stress on yourself during the period of the renovation, the purchase of that particular transaction. So again, when you're speaking to one of our advisors, when you're speaking to me, perhaps, we will ask an array of questions because ultimately we are trying to facilitate your need. We are trying to see an opportunity whereby we say we can help. It looks like this, and allow you to get comfortable with how that's structured. So, James Property Mortgages, we give you the opportunity to have direct access to personal mortgage advisors. Again, with an array of experience across all the products we've touched on. So residential, buy-to-let, bridging, commercial, specialist buy-to-let. So HMOs, MUFB. When your inquiry comes in, I make sure that it goes to the right person so that you're getting access to someone with a skill set. We're quite fortunate at JPM that the majority of our advisors have the skill set across all the products. But ultimately, we want your journey to be one of relative calm and ease, and happy with the outcome. So we try and tailor the advisor for your inquiry. We have access to over 180 lenders across your vanilla high street lenders, your Halifax, your Nationwide, your NatWests, as well as your boutique type lenders, your specialist buy-to-let lenders, commercial lenders. We have direct access to all of them due to our relationship with our network. We are improving the solicitor panel offering, and there'll be more information on that in the coming days and weeks, which again is across the advisors will tailor the solicitor for your particular lender because you may or may not know, but lenders do have closed solicitor panels. So we try and make sure we make that journey as easy and as simple as possible for you. Building and contents. Again, buying an asset requires building and contents. We work with a firm that is exceptional in terms of being able to do very standard building and contents policies, but also the more complex in terms of actually I'm doing a development and I need to ensure that I've got employer liability cover, I've got my works are covered, I've got hazard cover, and they can tailor the package for whatever project you're working on. So the building and contents team that we use are exceptional in terms of their experience.
Sorry, Mike. I had to mute you because someone had the mic on. So unmute, please. Yeah.
But I was going to say, I'm on a couple of jobs at the moment.
Who's talking?
Should I call you and say about 1:30, 2 o'clock?
Okay, sorry, I found him. It was Vince. Vince.
It's all right, mate. Sorry. Where did you mute me? Do you want me to go back?
No. I just about 30 seconds back. Yeah.
All right, brilliant. Right. So, do you want to touch on Mortgage Wallet, James?
Yeah, let me touch on that. So actually, I'm going to share my screen. Can you unshare yours, Mike? And I'll take over on Mortgage Wallet because I've been using this new tool that we're looking to We're looking to roll it out pretty soon. And essentially, what it is, if I can just give you a quick idea, my mortgage broker Carly at JPM, she probably thinks I'm the worst type of client because I'm very slow at uploading my documents, bank statements, self-assessments, utility bills, etc. But also, we had a chat with the team and we wanted to see how we could actually improve the service of applications that come through JPM to get your bridging finance or HMO mortgage, whatever it might be, what Mike's touched on today. So we have started to roll out this new mortgage wallet app. This is basically a screenshot of my dashboard on the app. You've got a few things on there. 3 key things would be a status update, contacting your broker live, and having a place where you can upload documents safely and encrypted. If we're looking at the status update, this is basically my refinance that I've got going through now on a buy-to-let property. I've done the stage 1, so I've got my mortgage certificate, I've done the application, and now the valuation and survey has been booked. So I'm always kept in the loop on where my application is instead of, well, you could ring your broker, you could ring your solicitor, but essentially it's all in the app for you to see where you are. At every stage of the being able to track your progress, it will give you information. So, for example, it will say the valuation or survey has now been instructed, and you can always contact the broker easily through live chat. So, one of the biggest things for me is I use my phone quite a lot, but I don't really have my laptop with me at times. So obviously, if I, instead of emailing back and forth my broker, there's a place inside this app where you can basically live chat and upload documents, nice and simple. And me and Carly have been testing it out. And if you're worried about any kind of encryption issues, it's fully encrypted. And me and Mike, we had a meeting with the founder of this app, and he was telling us that it's military grade. So you're able to not only upload documents and ID, review your mortgage terms and conditions, but you can also sign documents, e-sign them within the app as well, which is quite useful, and everything's kept in one place. So yeah, that's basically an overview of what we're starting to implement into James Property Mortgages. And the final feature that we've got is that once you actually complete on a mortgage, it automatically starts a countdown. So for example, mine's on a 5-year fix. So it means that I'll have a notification when this is coming to an end. It tells me the estimated remaining balance and obviously the date when I can start renewing to start looking for another fix before I get moved on to the standard variable rate. So that is the wrapping up towards the end of the presentation. Mike, a big thank you for giving us some information. We do have some Q&As, which I will discuss shortly, but before then we did have a couple of questions in the chat for you, Mike. One of them being that for development bridging, is there a product yet for taking a 3-bed house and converting it into a 5-bedroom HMO?
Just reading it.
Yeah, are you reading it as well? It's quite.
Yeah,
This will
yeah,
then
no.
have a provider lease in place for 5 to 10 years. So he's talking about a housing association, I think, here,
Yeah.
which adds a level of value, but not like a traditional HMO. So
Yeah. So, okay.
for development bridging, is there a product yet for taking a 3-bed house and converting it into a 5-bedroom HMO? Aha. So he's looking at initially using a development bridge to acquire the property.
Yeah, so yes, the answer is yes. We've got one at the moment. The grey bit, if you like, it's not grey. It's the exit lender obviously needs to see or needs to understand what the social housing supported housing contract looks like, and that is the key part. So the development finance bit is easy, and yes, under permitted development, not a problem. Lenders that will do it. The bit is, and again, for your insight, as a mortgage advisory firm, when we are talking about bridging finance, which is a great tool, we also talk about the exit, because the exit is quite frankly slightly more important than the actual bridge in some instances, because if you can't get out of the bridge, then we can't put you in a bridge. So if you know that you want to work within social housing, supported housing, typically you would want to understand what that lease looks like, so that we can then work with a number of exit lenders. Now that might be 6, 9, 12 months down the line, but we would want to give you the reassurance that we've got a home for your property in that time frame, and that lender is happy with that lease. So don't be surprised if the advisor asks you for a copy of the lease, because we'd want to understand if there's any sort of finer detail, the finer sort of nuances, if you like, of that lease, to make sure that we can get you out and there's a home for it. Typically, for again, from a social housing supported living point of view, the lending numbers aren't huge. And there are lenders that say they will do it, and some lenders need the firms to be on the registered charities list. A lot of these firms now aren't. So again, we need to go to some lenders that have flexibility and have an understanding and that will accept these contracts. But the best thing that we can do is go to the 6, 7, 8 lenders, subject to the finer detail of property values, etc., and get them to sign off on the lease, or give us as a firmer response as they can, to make sure that we can get you out. But yeah, we can look at that, not a problem.
I just want to ask everybody who's in the meeting, if you wanted to ask Mike or myself a question directly, please do feel free to unmute your mic. I can read them out, but it's also quite nice and interesting if you wanted to jump on and ask the question. If someone wants to do that now, feel free, or I will continue reading out the messages. Maybe. Okay, I will continue reading out. So there is
Hi, James. Sorry.
Go for it.
Hello. Thank you very much. I've been following you for a bit, and fantastic work you do. My question is relatively new. I'm going to do a little bit more research on the bridging, which is an area where I am really keen on. Is, say I've got and this caught my attention while the speaker was talking, was if I had something like 15,000 and I'm looking through your deals and I find one that I can actually pay totally, but I've got 15 grand, and it's a particularly new company that's just set up. Is it workable that everything works through you? I just come with my 15 grand, my new company, and say, look, I like this deal. It's about 44K to buy it out. And every other thing, I just want everything to run by you. And I'll pay any other thing outside of,
Yeah.
sort of.
So you mean like an end-to-end service, essentially?
Yes, basically.
Yeah. Yes, pretty much everything. So what I would say is that when it comes down to finding a property, we have the marketplace, which hopefully you can see on your screen now. And then we look to obviously the financing aspect, because a lot of investors use finance. They leverage the bank's money or other people's money to acquire the property, like what Mike's discussed today. So we've got James Property Mortgages for finance. And then if you need any other services along the way, so you can set up your business bank account, you can hit over to the services tab. We've got a solicitors panel. We've got project management teams, but the project management team is currently only limited to the area of Yorkshire and Humberside. We can try and help you in other areas, but that's kind of where our reputable team is working at the minute. Letting agencies, we can work nationwide. Landlord and building insurance, Mike and the team can help with that at James Property Mortgages. And also we've got planning permission services as well. So if you're acquiring let's say a family house, C3, and you want to convert it into a HMO, we've got the service for that as well. And actually today, guys, we've just released a new service, which is a JV partner opportunity. So we're going to try and match joint venture partners together. So you might have the money, but not necessarily the experience, or vice versa, and you need a partner to go into this. We're also helping with that level of service as well. So yeah, to answer your question, yeah, we do have like the full end-to-end if you needed to use us. Yeah, but you're not obliged to, of course.
Thank you.
Good question. Thank you. Anyone else would like to ask a question?
Can I ask a question,
Yuan
please?
Min. Yeah, good to see you.
Thank you both for organizing this meeting. It's very informative. So what's the current mortgage rate for yield-based finance for like 3-bed en-suite HMO?
Mike, you take that one. What do you think is the typical mortgage rate for an income-based valuation? But on a 3-bed, that might be quite difficult. Mike,
because what you got to bear in mind is that I'm answering this wrong. Apologies, but anything that's a 3-bed is a bricks and mortar valuation. You aren't going to get an income yield valuation, and to add some context to that is what you've got to bear in mind is banks tend to look at worst case scenario in the sense that if they ever had to repossess a property off me, what is their path of least resistance to sell that property and recover their funds? And ultimately, a 3-bed asset is worth what a 3-bed asset is worth. It's not worth just because you are extremely savvy and have managed to negotiate a really good deal and are getting strong rental yields for it. That isn't atypical for possibly the area that it's in the sense of if a bank had to take it back and sell it, then they would. Has she gone?
No. It's
all right. The bank had to take it back and sell it, then they would sell it to recover their money, and it may well be just as a family home. It may well be to another investor, but that investor might just get standard rent for it. So 3-bed, 4-bed is typically bricks and mortar value. We have got scenarios where we can get what's called a complex survey, where you've got 4- and 5-bed HMOs that have en suites rather than shared bathrooms, because there's that level of, well, actually, it's more appealing to the investor, which means that they will take a view. Typically, anything over 6, we can look to push out for a commercial valuation based on the income.
Yeah.
Right. Thank you.
Does that help?
Sorry. Yeah, it's helpful, but I did reach out quite a lot, and I got one mortgage product I got is 5.6% for 3-bed HMO, but the interest is £600 per month. But right. I don't know is it a right product or not, because
if we're talking rate specific.
Was that us that quoted that? Was it JPM or was it a different broker?
No, I sent an email, but to be honest, I haven't gotten a reply from JPM. So
well, we need to have a look at that.
I'll pick that up after. Don't worry, I'll pick that up after. For a 3-bed, to answer your question, I would expect lower rates than that. Now, I'm going to do what I would do typically, and that is subject to obviously circumstance and situation. But as a general rule, for a 3-bed, I would expect to see alternative cheaper rates than 5.6.
Mm-hmm. Cheaper than 5.6. Okay. Yeah.
But I've made a note of your name, and I'll look into that one after this.
Okay. Yeah. Thank you.
Just to give an idea of differences between a bricks and mortar and a income-based valuation. Income-based valuation is essentially based on what that property could achieve. So they're looking at more of like a commercial on, how much that rental income of the property. Usually the valuation is higher. But when you look at a typical bricks and mortar, which is for the majority of your buy-to-let properties, your smaller HMOs, they will obviously then start to take into consideration a radius of the local properties that have sold in the area we can see here. And then they'll base that on an average price per square foot. They'll tell you the distance, and that's kind of where you'll get the bricks and mortar. But yeah, as Mike said, and in my experience of investing, 3s and 4-beds will typically be your bricks and mortar, and then your 5-beds is where you'll start to get some lenders entering the market, I think, to give you that rental income based valuation. So yeah, we've got lots of questions. We actually had a full meeting today. There was a maximum of 100 participants, and we maxed out. So that was great attendance, guys. So thank you all for joining. I want to get through as many more questions as possible. Does anybody want to, if you wrote the question, do you want to jump in and ask it on the mic?
Hi, James.
Yeah, go, Emma. Hi, Emma.
Hi there. Could I just ask a question? Sorry, I have been following you for a while, but I've not been heavily involved. So this is my first one I've jumped on. So hi.
Hi.
I just want to ask a question. So we essentially bought a property as a standard buy-to-let. It's been refurbished. It's had a loft conversion. It's been converted from a 3-bedroom semi-detached bungalow into a 4-bedroom dormer bungalow. Lots of parking, good sized exterior gardens, etc. It's been refurbed throughout everything, roof, rewire the lot. We've took a mortgage on it because we bought the property and had to refinance to pull the funds back. So we've took a buy-to-let mortgage on it. It's not yet gone out to market to put a tenant in. And having spoken to, I work in the care industry, and having spoken to a few people, they've suggested that it might be prevalent to look at doing a commercial lease to a care provider. Now, obviously, we've already gone and done the refinance as a standard domestic buy-to-let. So my question to you is, if we were to look at doing that route, are there, I suppose the question for yourself and Michael, are there lenders out there that would look to lend on that? Obviously, I realise to get out of the existing mortgage you've just taken is going to have a penalty. So, but it could be quite lucrative to do a commercial lease with a care provider, which would substantially far outweigh a domestic buy-to-let. So that's my question. Bit long-winded, but I just wondered
Who's the current lender, Emma? Without
the current lender. I knew you were going to ask me that off the top of my head because it's been a couple of months since we've done it. I can't remember.
Is it High Street or?
Yeah, Leeds Building Society. I did it through a
Right.
broker. It wasn't yourselves.
Yeah.
I didn't know at that point you were
Sorry,
doing it.
don't worry, don't take offence.
But going
I'm
forward,
taking offence.
obviously. But yeah, we did it through the Leeds. So we got a decent rate, but obviously they're not going to let us do commercial lease. I'm aware of that.
So to answer your question, you've got to look at it in the sense that the rental income that you're going to get from the commercial lease is, as you say, is going to far outweigh what you are getting from a standard family tenancy.
Yes.
From the bank's perspective, they are, because it is, this is not going to sound the way it's meant to, but because it is a standard house that you've spent a lot of money on, tender love and care, increased its value, it is still a standard house, 4-bed house. So the value is what the value is. The benefit is just purely based on the passive rental income and the uplift on it. So if you, again, you don't answer this, but if you maxed out the LTV with Leeds, and you were at the highest LTV at say 75%, then
we're not, but
then obviously to come away, early repayment charges, etc., you wouldn't be leveraging anymore, but there will be lenders that would take the social housing council lease, etc., and lend against it. It's just I'm an advocate of looking at the numbers, and ultimately if the numbers mean that you pay the early repayment charge, don't have the lender beating down your door because the council are putting complaints in or registering things, and lenders
what we're looking at doing is leasing it to a private care provider, not necessarily council care provider. So doing it through a private care provider who obviously you get a fully insuring and repairing lease with a delapse at the end, delapse clause at the end. It just, the numbers are completely different to the domestic.
So Emma, are you worried about, because you might have chosen the wrong mortgage product? Mike, maybe you can.
I'm wondering how easy it would be to go over, really.
No, I mean, the only thing,
expertise in.
Yeah, I mean, from your perspective, Emma, I mean, this is I like these types of conversations because there's that due diligence on your part to make sure you're doing it the right way. And ultimately, the only thing you've got to be aware of is, one, yes, there are lenders that will facilitate the care side of it. That's fine.
Is there many that will do that? Is really my question. Is it quite?
Yeah, there are lenders that will do it. The only thing that you've got to factor in is what the ERC is, and ultimately how long you're going to recover that from the uplifting rent. That would be where I would go with it.
So, Mike, are you saying that the buy-to-let mortgage product isn't the correct product for something?
No, it's not. So what you've got to bear in mind, James, is that buy-to-let mortgage is it's a bit similar to the bridge in the sense of how it's morphed, if you like. So back in 2004, 2005, when you had Birmingham Midshires in the market, and that was about it, doing 85% loan to value, and people were buying them and just letting them out to families, and the bank wouldn't even entertain housing benefit, never mind a structure of a care facility.
We were aware that the T's and C's involved with the leads is just like, it's honestly, it's toe curling. You look at them and you decide, do I really want to sign?
Yeah, and that's it. I mean, the problem that you've got is that it's that worst case scenario, that vulnerability. Some lenders are just really uncomfortable with the fact, and this is the bit people probably don't understand, or they might do. The client is responsible for paying the mortgage.
Yeah.
The tenant, the vulnerable tenant, can't make the client pay the mortgage. And if the mortgage isn't being paid and the bank want to go and repossess, they're actually putting themselves in a situation where they're potentially putting vulnerable people out on the street because the client hasn't paid the mortgage, and some banks just don't want to be associated with that. And you've got other banks that are quite happy to take the view. Now, you will pay slightly more on the rate. You possibly won't get a leads rate.
I'm assuming it would be a commercial mortgage, would it, for that?
Well, again, you've got buy-to-let specialist lenders that aren't necessarily commercial, but they will lend on a commercial lease, if you like. But then you've also got commercial lenders that will take a view, and it's all about the numbers, Emma, because once you sort of go into the commercial space, you're in a situation where some of the commercial lenders, their criteria for property values and lending is significantly higher than your atypical sort of buy-to-let term mortgage lender. So it's about the finer detail in terms of your particular circumstances and where it would. But what I would say is that from your perspective, there's no harm in understanding what that looks like, because that's just a fact-finding piece of information for you to allow you to make an informed decision.
Yeah,
Emma,
maybe if you could reach out to me following this, that'd be good to have a chat about that.
When does your fixed term end with Leeds?
We've literally just taken it out.
Oh dear.
So it was a really bad decision, and it was a conversation that we sort of had following, and I'm sort of oh God, but that's why we haven't gone in yet.
Yeah, no cooling off period.
We're sort of on the fence. It's costing us money. We're on the fence. But if you know,
is it not worth maybe a phone call just to Leeds Building Society and letting them know? Maybe, I don't know if it's just
I think it's I've looked at that. It's a flat no. Yeah.
Oh, right. Oh, okay. No
So it's just whether we continue down the buy-to-let route. And
essentially you got weigh up your ERC versus what you're going to be getting for your commercial lease. Correct. And then hopefully it's not as bad as what it sounds. Hopefully
Michael, if you can reach out to me or vice versa following this, I'd love to have a chat with you about it. Thanks for your time.
Brilliant. Thanks, Emma. Also, I just wanted to let everybody know, because I know that we're getting to the end of it, and we've had a question about how much it actually is for JPM. So the pricing is, we don't hide any fees, standard mortgage, so buy-to-let HMO, holiday-let 495, always fixed, a standard bridge 495, and development finance 995, slightly more work. So that's just answering a question for James Property Mortgages fees. Was there any other questions? Thanks, Emma, by the way, for your question. Was there anyone else? Vince.
Yeah, sorry, I was trying to be patient, but I didn't want to get missed. Hi, Michael. Hi, James.
Hi, mate. You're right.
I was listening to what you're saying about finance based on the exit. First part of this question is, can I get finance for a property I would be maybe interested in buying in France? Or does all the finances have to be in the UK or for UK property? Yeah,
so in terms of lending, it's UK-based lending. We obviously can arrange more. This sort of contradicts what your question, but we can arrange finance for expats and foreign nationals. But we don't have any UK banks that actually lend on foreign soil.
So I'm still in the UK.
Yeah, no, but the assets abroad, though, isn't it?
Oh, I see. Yes, yeah, you're right.
Yeah. So, but we do have an advisor that we work with externally that does European mortgages. So and this is probably we didn't really touch on it, but it's probably one of the services in the sense of understanding your requirements is in that sense. It's like, well, this is what I want to do. Well, we've got a facility that we can access to have a conversation with you about looking to buy in France or Spain. He's a very well established advisor that purely deals with European mortgages.
Okay, so I'll try and be quick. So I've got a residential primary residence here in the UK, and I've got a investment property, which is an off-plan new build still being built. So I will have equity from both properties available if I had to use it. What I was trying to do is buy a holiday let in France, which would be used as a gîte most of the year, and then I would just use it when it was empty.
Yeah.
So I don't know if I could get a mortgage in France because it's primarily a holiday let. So I got really confused about where the money would come from.
I'll be honest, Vince, it's one of them that we can more than happy to explore what options are available. And again, as we touched on earlier in the sort of the conversation, once we understand, obviously it's not for now, but once we understand the whole picture, it's saying, well, actually, we might be able to do this, do that, do the other, and that then ties in with some borrowing in France or against the European asset, and how that, and just presenting that back to you and say, look, this might be a solution, but we do have an advisor that we use for European mortgages, so we would work together to try and find a solution for you.
That would be income based, I guess, because the property I'm looking at is actually 3 houses, which 2 are currently already being let out as gîtes. One is the family residence, which could equally be rented out, and it could generate quite a good income. So again,
sounds interesting. I'm looking forward to the invite.
Yeah. So how would do I approach you? Do I email you?
Just drop me an email, mate. We can take this offline.
If you need to contact JPM, you can. We're on WhatsApp, we're on email. It's all here. Hello@James Property Mortgages, or just go to the website and you'll be able to contact us here.
What I'll do, Vince, it'll come through to me. Everything's interlinked, so it'll come through to me, and we can pick it up. And initially, I'll reach out to you. We'll have a conversation, and then I can pass it out to one of the advisors and see what we can do to help.
Okay, great. Thank you. Appreciate that.
No, pleasure, mate. Absolute pleasure.
Thank you very much.
We had a question from Farhan. He says, I'm currently in the process of buying a property through auction with cash. Once it's completed and I want to get a mortgage on it and release as much of my funds as possible and go again. I also want to do that. Can you help me with this process? I think
yes. What you've got to remember, Farhan, is that we have lending options whereby they will review the situation within 6 months. There's a number of lenders that will allow that, where we can evidence uplift in value, we can evidence the spend that you've done to renovate and refurbish the property, and we can pull the money out as quickly as possible in terms of a refinance. We have other lenders that require you to own it for 6 months, and are very prescriptive on that sort of that piece of criteria. My comment to yourself would be to, as soon as it's ready or nearly ready, maybe the carpets are going down in a week's time or a fortnight's time, reach out. We can do the initial conversation, understand your options, and potentially have a valuer out in time for the day after the carpets have gone down.
Brilliant. Is there anything we can't do, Mike? I mean, we can do personal residential mortgages too, right? Is there anything else?
Oh no, mate, we can. Yeah, we do. Yeah,
we do pretty much everything.
Is there anything we can't do?
Let's not open that can of worms. Let's leave.
No, I'm going to say, mate,
we'll leave that one closed.
I'll be digging a hole for myself that I can't get out of.
Was there any more questions to Mike whilst we've got him here, because he's full of knowledge and value, and if there's any finance questions, we can ask him. But like you said, any inquiries, they will all filter through to Mike anyway, so it's not really going to be an issue. But we are approaching we've already passed it. I just wanted to remind everyone that we have, for JPU students next week, I've got a masterclass about how to legally pay no stamp duty. So that's coming up. And if you are wanting to join the James Property University, we've just released our new waiting list. You can go to jamespropertyuniversity.io. You can find out more information there about how to join our next cohort, which is coming up in end of February. February 28th, I think, is our next launch date. And you'll be able to join our investor database, our investor community, or where we're literally just buying properties and investing in HMO, social housing, buy-to-lets, hybrid buy-to-lets, pretty much everything. So that's coming up soon. You can join the waiting list there. Okay, I'm going to wrap up. Thank you all for an enjoyable masterclass again. Mike, thank you so much for joining us. Let's do another one, Mike, in maybe a couple of months' time. We might have another mortgage update so we can get more information, what rates we're seeing, and just give more help out to others. So thanks everybody for joining, and we will see you all next time. Cheers.